Welcome back to your ultimate pit stop, Piston Pundit, where engines aren't the only things running hot. This time, we're revving into the fast lane of financial turmoil as the U.S. Treasury kicks off a massive $514 billion borrowing spree. The dollar nosedives and global investors slam the brakes on American assets. Tariffs are back in full throttle, trade tensions are spiking, and the economy? It's idling on the edge. We'll break down how each of these developments is rattling the automotive world, and why it matters for your wallet, your wrench, and your weekend drives. Buckle up. Here are the key points shifting this economic gear. A $514 billion cash burn. Treasury hits the gas on debt. In a bold pivot, the U.S. Treasury announced plans to borrow $514 billion for Q2 2025, blowing past its earlier $123 billion estimate. The 317% surge stems from a weaker-than-expected cash starting point and tighter net inflows, all while targeting an $850 billion reserve by June, if Congress addresses the debt ceiling in time. This sharp increase highlights mounting fiscal strain. Since the debt ceiling was reinstated in January, the Treasury has been operating under tight constraints, leading to a liquidity crunch and urgent borrowing needs. Markets are split. Some investors see the move as essential to keeping the government running smoothly. Others worry it could spike interest rates, raise inflation risks, and make credit more expensive for households and businesses alike. Beyond the immediate cash flow issue, this borrowing spree mirrors larger uncertainties, from trade policies to market volatility. The road ahead isn't just about numbers, it's about whether Washington can steer clear of default and restore confidence. For investors and consumers alike, the government's financial management is now squarely in the spotlight. And speaking of global reactions, let's talk about what's happening with the US dollar. Foreign capital stalls as the dollar breaks down. As of April 2, 2025, the US dollar has sputtered to a 9.2% decline, the worst tailspin since the 2008 crash. It's not just a blip. This is a full-blown confidence crisis. Triggered by trade turmoil and debt worries, the greenback slump has sent a clear signal. Global investors are shifting into reverse. Over a 2-week stretch, foreign investors dumped $36 billion in U.S. treasuries, sparking concerns about America's appeal as a safe haven. The depreciation of the dollar might boost U.S. exports on paper, but for import-heavy sectors, like automotive manufacturing, it's a cost-raising nightmare. From steel to semiconductors, import bills are climbing fast, dragging inflation in their wake. Where's the smart money heading? Gold. Lots of it. In just 1 week, $15 billion flowed into the precious metal as central banks, especially in China and India, hedged their bets against dollar-denominated assets. That's not just diversification, it's a strategic dodge from what they view as an unstable American engine. With the dollar in a slide and capital outflows accelerating, the U.S. faces a precarious position. For gearheads and garage businesses alike, the knock-on effects could show up in parts costs, interest rates, and long-term financing. Stability for now is running lean. But currency pressure isn't the only force grinding gears. Let's talk tariffs. Before we delve deeper, do us a favor and smash that like and subscribe button. It helps us reach more car enthusiasts who care about how policy hits the pavement, just like you. Tariffs slam the economy into reverse gear. The Trump administration's 145% tariff on Chinese imports in April 2025 triggered swift retaliation. China hit back with a 125% tariff on U.S. goods. The result? A trade war that's jamming up global supply chains and turbocharging costs across industries. The fallout is already showing under the hood. U.S. GDP shrank by 0.3% in Q1, the first contraction since 2022, driven by panic importing ahead of tariffs and a pullback in government spending. Consumer confidence also slid to its lowest since May 2020. Major players are feeling the pinch. Apple reported a staggering $900 million in tariff-related expenses. Meanwhile, importers of key components like solar panels and industrial chemicals are seeing profit margins collapse by up to 40%. It's not just Wall Street feeling the drag. These ripple effects are reaching the factory floor, dealership lots, and eventually, your garage. Tariffs may aim to protect U.S. industries, but the rising costs and disrupted trade flows suggest the cure may be bruising the patient. Policymakers now face a high-stakes balancing act between protectionism and economic pain. So how does the administration justify this aggressive approach? Enter Scott Bessent. Bessent's blueprint meets real-world resistance. At the Milken Institute Global Conference, Treasury Secretary Scott Bessent stepped up with a confident pitch. America, despite the chaos, remains the Schelling point of global finance. His strategy? A three-pronged approach of trade reform, tax cuts, and deregulation. A familiar formula meant to reignite growth. He painted a future of streamlined permits, lighter regulatory loads, and investor-friendly policy shifts. The goal was clear: reassure a jittery market that the U.S. still offers unmatched capital depth and solid legal protections. But not everyone bought into Bessent's engine rebuild. Citadel's Ken Griffin didn't mince words, calling the tariff regime crony capitalism, a system where government picks the winners and leaves the rest in the dust. Other financial heavyweights echoed concerns, flagging unpredictability as a major drag on long-term confidence. In theory, Bessent's plan revs up the economy. In practice, it'll take more than fine-tuned speeches. Investors want more than a roadmap. They want results under the hood. Until that's delivered, skepticism will continue to idle in the background. Which brings us to the road ahead. Tight turns and steep climbs ahead. As the economic journey continues, the U.S. faces a high-torque uphill battle. The Treasury's $514 billion borrowing move raises red flags over whether government debt is crowding out private capital. That matters to gearheads and business owners alike, as rising rates can slow credit and stall growth. And then there's the tariff trap. Trade tensions aren't just political noise, they're impacting balance sheets. Nations slapped with tariffs are finding other lanes, building new trade alliances that could steer influence away from U.S. markets. If America wants to stay in the driver's seat, it must adjust to a world that's shifting gears fast. Meanwhile, investor confidence is still running cold. The pivot to gold and foreign assets reflects more than short-term nerves. It's a signal that global players are waiting for proof that the U.S. can steady its course. At Piston Pundit, we've seen how quickly economic policy can trickle into the shop floor, raising part costs, shifting supplier routes, and straining consumer demand. Whether it's Wall Street or a small-town garage, the ripple effects are real. So where does this all leave us? Let's bring it home with our final verdict. Final verdict: holding the line in unstable times. The U.S. economy is hitting a critical crossroads. With the Treasury's record-breaking $514 billion borrowing plan, a weakening dollar, and a wave of investor skepticism, it's clear the road ahead demands bold yet balanced economic policy. Trade reforms, tax incentives, and deregulation may offer a route to recovery, but potholes remain. Global trust hinges on more than promises. It requires proof, real economic resilience, and strategic navigation through the turbulence. So what do you think? Will this aggressive borrowing strategy turbocharge growth or overheat the system? Are foreign investors right to flee U.S. markets, or is this just a temporary detour? Can America regain its economic edge without compromising global partnerships? Drop your thoughts, takes, or wrench-side opinions in the comments below. And if you haven't already, hit that subscribe button to stay tuned for more vehicle updates, trade breakdowns, and real-world auto insights. Thanks for watching, and see you next time. You can now check out any of the videos on the screen. There's plenty more to explore.